Hello and welcome to another episode of StockMaven. Today, we are going to talk about what is gamma in options trading. Options trading can be a great way to make money in the stock market, but it is also very complex. There are many different terms and concepts that you need to understand if you want to be successful. One of those terms is gamma. Gamma is a measure of how much an option's delta changes in response to a 1-point change in the underlying asset. Delta is the measure of how much the option's price changes in response to a 1-point change in the underlying asset. In other words, gamma tells you how much the delta will change for a given move in the underlying asset. For example, if an option has a delta of 0.50 and a gamma of 0.10, then if the underlying asset moves up by 1 point, the delta of the option will increase to 0.60. So, why is gamma important? Gamma can be very useful in helping you to understand the risks and potential rewards of an options trade. It can also help you to determine the right strategy to use in different market conditions. For example, if you are bullish on a stock and you think it is going to go up, you might want to buy a call option. However, if the stock is very volatile, then the gamma of the call option might be very high. This means that the delta of the option could change dramatically in response to small changes in the underlying asset. On the other hand, if you are bearish on a stock and you think it is going to go down, you might want to buy a put option. Again, if the stock is very volatile, then the gamma of the put option might be very high. This means that the delta of the option could change dramatically in response to small changes in the underlying asset. So, how can you use gamma to your advantage in options trading? One way is to use it to manage your risk. By understanding the gamma of your options, you can adjust your position as the underlying asset moves to minimize your losses and maximize your profits. Another way to use gamma is to take advantage of market volatility. When the market is very volatile, the gamma of options tends to be very high. This means that you can make a lot of money by buying options when the market is volatile and then selling them when the market stabilizes. Gamma is an important concept to understand when it comes to options trading. It is one of the Greeks, which are measures that help traders understand the various risks and opportunities associated with options. In simple terms, gamma measures how much the delta of an option changes as the underlying asset's price changes. Delta is another Greek, and it measures the rate of change of an option's price in relation to the underlying asset's price. Essentially, gamma measures the rate of change of delta. Gamma is a positive number for both call and put options. As the underlying asset's price increases, the gamma of a call option will increase, while the gamma of a put option will decrease. Conversely, as the underlying asset's price decreases, the gamma of a call option will decrease, while the gamma of a put option will increase. Traders need to understand gamma because it can help them manage their risk. If a trader has a position that has a high gamma, it means that the delta of the position can change rapidly with small movements in the underlying asset's price. This can make the position more volatile and increase the risk associated with it. For example, let's say a trader has a portfolio that consists of call options with a high gamma. If the underlying asset's price suddenly moves, the delta of the portfolio could change rapidly. This could lead to large gains or losses depending on the direction of the price movement. On the other hand, if a trader has a position with a low gamma, it means that the delta of the position will change more slowly with movements in the underlying asset's price. This can make the position less volatile and reduce the risk associated with it. Another factor that can affect gamma is time to expiration. As an option nears expiration, its gamma tends to increase, making it more sensitive to price movements. This is because as an option approaches its expiration date, its value is increasingly tied to the underlying asset's price. Finally, it's important to note that gamma is not constant and can change as the underlying asset's price and volatility change. This means that traders need to continually monitor gamma levels to adjust their options strategies accordingly. One way to do this is by using gamma hedging techniques, such as delta hedging. Delta hedging involves buying or selling the underlying asset in a way that offsets the delta of the option's position. This can help neutralize the impact of gamma and minimize risk. In summary, a gamma is a crucial option Greek that measures the rate of change of an option's delta in relation to changes in the underlying asset's price. A high gamma value indicates that an option's delta is highly sensitive to price movements, while a low gamma value indicates the opposite. Gamma can be affected by factors such as volatility, time to expiration, and changes in the underlying asset's price. Traders can use gamma hedging techniques like delta hedging to manage risk and optimize their options strategies. That's all for today's episode. Thank you for watching StockMaven. Please like, share and subscribe for more videos on cryptocurrency markets and important news.